Hello, hello, hello. Welcome to everybody. So glad that you're all able to join us. I know this is your lunchtime, so we're going to get started in about a minute. Casey's going to come on here and he's going to talk about lending for investors. So this is a great program for those of you that run into investors out there. Maybe you're even just holding an open house and you have an investor that happens to walk in. How do you know if this investor is a qualified investor? How do you know if this is somebody that you should actually spend your time with? So that's what we're going to be covering today. If you want to go ahead and get your sandwiches out, we can't see anybody on screen, as you know, so eat away. Please put your questions in the chat. I will be manning the chat, and so will Melissa. And without further ado, it's exactly 12 o'clock. So I'm going to go ahead and bring on my husband, Casey Sullivan. So Casey, why don't you go ahead and teach us everything we need to know?
Sounds good. Thanks for the intro. So we're definitely glad you're here, and we would love your feedback as you listen to this webinar. We will pop open a survey kind of near the end of this short webinar. So anything you can do to provide us some feedback is great. After the webinar, you will get an email with a link to this webinar if you want to watch it again or share it with somebody. And feel free to jump into the chat if you would like. There's both public and private, and we're happy to answer any questions you may have. So what we're going to go through is the kind of loans for investors, but let's start with a quick introduction. I work for a company. I run a branch of a mortgage company called CrossCountry Mortgage. We're currently, and have been for the last few years, the #1 retail mortgage lender and the #1 non-QM lender in America. We just don't advertise on the Super Bowl, so not everybody knows about us, but we've got a great product mix due to our size. I run the Sullivan Group, and my team primarily consists of me as the loan officer and the branch manager, my wife, Nikki, who does business development and supports our realtors. We've got an ops manager, Nicole. Teresa's our pre-approval specialist, and Melissa's our marketing coordinator. In a branch, we would also have loan officers and processors and underwriters and all those people as well. We do lend in all 50 states, including Puerto Rico, and we are always hiring, just in case you know of a great support staff or a great loan officer that is looking to grow their business. So why would you partner with us? So we're definitely a professional and accountable lender. We do not like surprises. We really like underwriting approvals and quick or no contingencies and quick closings. And we are real people. We are not just an internet bot. We do love helping our buyers and your buyers by really making sure we follow up on the lead. We call it the no lead left behind. We like to offer a closing guarantee if that can help. We offer our buyers free FIs and true term free FIs to save money when rates drop. We really do full consultations with our buyers to both educate them on the process of buying either their first house or their 10th house, and also all the details they need to know so that they're comfortable when they actually get into contract. And we can also help you with your listings by doing, financing flyers, both the old-fashioned paper ones and online options. If you take a listing or preparing to take a listing in a condo, we're always happy to pre-approve the condo complex itself. Nothing to do with the buyer, but just the condo to make sure we're okay with how the condo may work for FHA or VA or conventional lending. And then for our VIP partners, we really want to help you sell your listings, especially those that might be stale. We want to help you sell them like the builders do. And if you look at enough builders, they love to offer temporary buy downs that are paid by the lender. So we're happy to help you with that as well. So let's jump into today's presentation. So this is the key topics is kind of what's the problem, what's our top solution, some cues to listen for, and maybe how to market this information out to your clients. So what's the problem? Why do investors struggle with traditional lending? That's the problem we're facing here. So banks often will always require traditional income and debt to income ratios that investors just may not meet. They may also run into issues qualifying with what's on paper because maybe their income and their equity is tied up in properties. And many investors get denied because they just don't fit that conventional box. And so for realtors, that really means lost deals, missed closings, and frustrated clients. And so our solution is, we really work to turn that no into a yes, and we'll qualify somebody based upon the property cash flow or their assets, not just their income or tax returns. We do offer in-house approvals, meaning, faster, closes the big banks or brokers because we're making the decision here. And the goal is really to make the loan fit the deal, not the other way around. So our top solutions, which I'll go into more detail on further slides, is what we call a DSCR loan, and that's where we're qualifying based upon the property cash flow only. An asset-only loan, another great solution is a fix and flip loan or a bridge loan. And so with the investor cash flow, or the DSCR is what some lenders will call it, which stands for debt service coverage ratio, but let's just call it the investor cash flow loan. What it is we don't look at income documents, no tax returns. We're solely qualifying this purchase based upon the subject property's cash flow. It can be used for refinances as well, and we're again only looking at the subject property cash flow. It does allow for faster closings for investors who need to move quickly through the process. It works great for rental portfolios, whether it's single family, multifamily, short-term rentals. There isn't the restrictions that you may see on conventional loans where you might only be able to have 5 or 10 finance properties. This is fine for, dozens of properties. It can really be used to expand an existing portfolio without hitting the traditional, what we call debt to income roadblocks that you see in traditional lending. And it's really the only loan that allows for a direct purchase into an LLC. A traditional mortgage, say a Fannie Mae, Freddie Mac mortgage, does not allow a buyer to buy in an LLC. They actually don't want you to transfer it into an LLC later if you follow the deed of trust. But with this investor cash flow, you can actually write your purchase contract in the name of an LLC, and your individual name never kind of shows up on the contract or on the loan. So, you're still the signer on it, but your LLC is the name that's used. So the script here when you're talking to people is, something along the lines of, my lender has a loan that qualifies you based upon rental income, not your personal income. If the rent covers your mortgage, you're good. A scenario yesterday, I talked to a person who really just didn't have the right income on their taxes. They owned a rental property. They actually did not have a loan on it. They were looking to add an ADU and they needed some cash out. So this was the angle we went. The property definitely cash flowed. It had a long-term rental in the primary house. So it really works for kind of both purchasing and also projects along the way. The minimum credit score is generally 620. Loan amounts can be large, up to 3.5 million. It's generally going to require 20% down. It's for investor properties only, hence the name investor cash flow. Again, the qualification is based upon the debt service coverage ratio, which is basically the rent versus the mortgage. So if the ratio is a 1.0, which means the rent exactly equals the mortgage. And when we say mortgage, that would be mortgage, taxes, insurance. If it exactly matches, so it's a 1-to-1 ratio, that is perfectly fine for first-time investors. Obviously, higher than that is great. A buyer can actually buy a property that is losing money, so it would be under a 1.0 ratio, and that's generally for somebody that's owned an investment property before. We did one recently where it was not breaking even, but the plan was he was going to do some rehab to it and change it from a duplex with 1 bedroom in each unit to 2 bedrooms in each unit. So he knew it would cash flow shortly. So that's the investor cash flow summary there. Now here's an example. So an investor wanted to buy a $900,000 duplex in Tennessee. And a traditional debt to income type mortgage qualification just did not work for this investor. But the rental income on the property was $6,500 a month. And it covered the mortgage and the expenses. And that's how we approved the loan. And it was a quick close. It was about 19 days there. So that's a success story to kind of look at. So again, any investor, We do find that people that do qualify with the full documentation and their taxes, sometimes they prefer this loan anyways, just because the interest rates aren't that much different, and it allows them to not have to provide taxes and a breakdown of all of their real estate owned. So investor cash flow, or DSCR, super popular right now. The next one I wanted to go over was the asset only loan. So this is where there's no debt to income requirements. Investors don't need to prove income streams, just assets. So this is really a good fit for, really high net worth investors who live off investments, retirement accounts, or business distributions. No tax returns or employment history is needed. The loan is strictly based upon asset verification. So it's really flexible. It works for primary, homes, second homes, and investment properties, which is what we're talking about today. Kind of, if you're talking to somebody, you could say something, if you have strong assets but low taxable income, my lender can help you qualify without tax returns. So this is similar to the DSCR loan. Again, we're not looking at taxes. With this asset-based loan, there's a few different ways to do it, but kind of the most common way is 620 credit score is what you're looking for. Again, loan amounts up to $3.5 million, works for primary, second investment. The down payment will vary based upon the credit score and the occupancy. So if somebody was buying an owner occupied, they could do 10%. But if they're looking to buy a second home, vacation home, or an investment property, they would need a minimum of 15% down. And again, we're only looking at assets, not income. And so for this asset only loan, here's an example. So an investor with $2.5 million in retirement and brokerage accounts is our consumer. But he's got no current income stream to qualify conventionally. We confirmed that he had 125% of the balance of the mortgage post-closing, which means he had 25% more than the loan amount that he was asking for in his account after he put the down payment. So he had that amount left over in his account, and we were able to approve him. This was a $1.2 million purchase, but solely based upon the liquid assets. So we figure if you've got 125% of the balance in your account after closing, well, you could just pay it off if you wanted to. So that gives us the peace of mind that the loan is in a good position and doable. So again, asset only. And this is the one that can be used for primary, second, or investment. Now, the next one is a fix and flip loan. So this one, that's a common term we hear out there, but it's basically designed for real estate investors that are buying distressed or undervalued properties. Rehab funds can be built directly into the loan, making it easier to finance both the purchase and the renovation with one loan approval. It's usually set up on a short-term structure, say 12 or 18 months, giving the investor time to complete the improvements and then to sell or refinance it. We're always looking at what's the exit strategy. So is it a fix and sell for profit, or is it a fix and rent? If you're in the investor world, you probably know the BRRRR, method, which is buy, rehab, rent, refinance, and repeat. So these are your investors that go out, find a great property, and instead of fixing and flipping it, they want to fix and hold it, and then they want to do it again. So these fix and flip loans allow them to get the property in a position to rent and then also qualify for traditional financing because it's no longer a distressed property. A great script is my lender, has a loan that covers both the purchase and the rehab costs. So you can buy, renovate, and then sell or refinance the property. These loans are generally set up with pretty fast closings, again, 12 to 18 months. There's no traditional underwriting on these. We're not looking at tax returns. That's kind of a theme here on this call, but not looking at tax returns. It's more just based upon this property. Fast closings, usually we say 7 to 10 days. Some investors might write a little bit longer than that in there. With this, again, the entities are okay. So somebody can use an LLC, for example, in order to buy and to, go through this transaction. The maximum financing on these is really going to be dependent upon the projects completed in the last 3 years. So if you have an investor that has not done a, fix and flip in the last 3 years, they would be considered a new investor, even if they've done them before. But, we look at the last 3 years. And it's going to be based upon how many they did. So if they've done more in the last 3 years, they'll get better interest rates, and they'll also get higher financing. Kind of what you would expect to be the best case scenario is for a seasoned investor that they could get 90% of the cost, so 90% of loan to cost. And the cost calculation is the purchase price plus the rehab. So they bring in 10% against the purchase and the rehab, and we'll fund 90% of it. That best case scenario. If you're a first-time investor, you might get a haircut down to say 85%. And then we also are always on a fix and flip looking at the ARV. So that's the after repair value or the future value of the home. So you buy it for a certain price, you do the rehab, and then you go to market it. What will it be worth? So with those, the best case scenario is 75% ARV, meaning the financing we can provide can't exceed 75% of the after repair value as set by an appraiser. Some of the transactions are set at 70%, so kind of think 70 to 75% after repair value. So that's how we did the math. When somebody finds a fix and flip property, we had somebody that found one yesterday. He is an investor, so he shoots me the address. He tells me what he's expecting to pay for the house. He tells me what his expected budget is to do the repairs. Obviously, he's just kind of guessing at this point by looking at it. And then what he thinks it will sell for afterwards, so the ARV. And then I get him some terms on it so he can see what it would look like on the financing side. So that's your fix and flip. Here's an example. Is we've got, investor purchased a distressed property at $400,000, $399. Their rehab budget was about $75,000. So our loan covered the purchase and the rehab costs at 90%. And 6 months later, they sold it for $615,000, which was a big profit and a fast turnaround of their money. So that's, again, your fix and flip investors. Some of these homes are on the market, through MLS, and they get the fix and flip investors coming through. Some of these are done off market. Either way, it's fine. These loans can also be used to make some significant improvements in a property. So you could take a single family, and as long as you go through the correct process with, permitting, you could turn it into a duplex, or you could make it into even a multifamily on the lot. So we have a client who was looking at one that was currently being run as an office, but the city would allow it to convert to a fourplex. So his plan was to basically rip it apart and build a fourplex, keeping somewhat of the same foundation to save costs. And then we're going to go through our last one. I'm kind of running through this fast, so we've got about a 30-minute window, so we'll finish before that. So I'll save you a little bit of time in your day. So looking at the kind of the fourth option for investors is called the bridge loan. And this term is very general. Bridge terms, the loan bridge loan can be applied to lots of different products. We're going to talk about it more on the investor side. So it basically provides, liquidity and fast, flexible funds for investors. It's not used, for rehab funding. It's more used to purchase a property. Unless you pull some cash out to do the rehab, but it's not actually set up for rehab funding. This can be also used for a reverse 1031 exchange. So let's say you have somebody who wants to do the 1031 exchange, but they know that, selling the property and then going out to try to find the replacement property in the required amount of time can be a little challenging, especially in certain markets where there isn't great inventory or they're looking for a specific type of property. So they could do a reverse 1031 exchange where we will put a lien against the properties, including the old one, in order to pull enough money out for the purchase of the new one, and then they can finish off the 1031 exchange afterwards. So that's a reverse 1031. It can be used for fix and flips. One creative way of using a bridge loan is if a consumer has equity in another property, could be a rental property, it could be a second home, it could be their primary residence, that they've got a good equity in that property, we can give them a bridge loan that will apply and allow them to pull the money out to buy the new property and also get some money for the rehab. So that's where you're just utilizing equity you've built up in other properties. It could be one property or multiple properties that you put up as collateral in order to get the bridge loan financing for what you're looking to do. These bridge loans can be flexible as well on what you're looking to buy. It could work for residential properties, commercial properties, or even mixed use. The exit strategy here is, generally sell the departing property, the one that you put the bridge loan on, or refinance the debt into long-term financing when kind of the dust settles. So an overall script could be something along the lines of, buy your next investment property without traditional underwriting. My lender has loans that can help bridge the gap. So again, we're dropping traditional underwriting and we're giving some flexibility to investors. So really, it has some flexible credit requirements. There isn't hard and set FICO requirements, but overall credit is looked at. Loans generally can be 5 million. There's exceptions that go above that, so usually the loan amounts are fine. The most common term is usually about 11 or 12 months of how long these loans stay open for. It's basically short-term financing. Again, residential, commercial, mixed use, and the loan to value that you would normally see is about 65 to 70%. And that would be against, kind of all properties that are being put up for collateral. So it can go against more than one. So that's a bridge loan in the way of how an investor may use that loan. Here's a quick example. An investor found a perfect fourplex at 1.75 million, but their current rental property hadn't sold yet. The traditional financing would have required them to require the first property to close before the purchase. Now with the bridge loan, they access equity in their current property to fund the down payment, and they were able to close and get the property taken care of. So bridge loans is just another way to look at it. Not as popular as the DSCR loans. So when we look at some quick little tools and resources, what to listen for in conversations to help us help more people is, I can't qualify because I already have too many mortgages, or maybe I don't show enough income on taxes, or I need funds to flip this property quickly. Those would be some great things that could pop up in conversations that may help. When you hear anything about this, flag it and connect the client with us early. We likely have a program that can fit their situation to help them with their next project. So how can you market this? Well, we provide co-branded tools and content to help you grow your business. You can find some resources on Linktree. Easiest way to get to my Linktree is to go to my Instagram bio, which is at the.sullivan.group. Look in the bio section and you'll see a link to Linktree, and you'll see we put together some flyers, put together some social media graphics and captions. We put together a script if you want to do a video or a reel. And we also put together some templates for email and newsletters, just trying to help you and, think about what your typical buyer profile is that could fit with. So you may work with investors. And so this could be something you could market out to those investors, or maybe you want to work with investors. So start talking about this with your clients and with your sphere of influence so that they know that you have resources to help them invest in the market. And maybe it's not even in our local area. Maybe you want to expand and help them buy in other markets. We are, as a mortgage lender, we are easy to introduce. So if you run into a client that could use our consulting and our strategy, is share our info with us. You can send out a joint email introduction, a joint text introduction, however you feel is best to help us get in contact with them. We're always happy to help and schedule some time to meet with them. And lastly, we do offer some other realtor resources. We offer networking happy hours with some local professionals so that you can meet, financial planners, CPAs, attorneys. We love to do education, things like these webinars and lunch and learns. And we also communicate weekly with a weekly newsletter that usually brings in current events or topics or products, and a market update, which is a voicemail if you're interested. So we thank you for coming today, and feel free to continue to chat in there or reach out if you have any questions afterwards. We can't hear you, Nikki, but thank you for wrapping us up. We are happy for those of you that joined us, and look forward to continuing our business relationship.